Okay, hello everyone, and thank you for taking out time to come at the EPGP Seminar Series. So every day in newspapers, we really see some or the other startups getting funded and getting gigantic valuations, and often think how they are getting valued, what's in the VC space in India, and what would be the next. So this time in Seminar Series, the topic is venture capital in India. And after quite search, we realized there can't be a better person than Abhishek. So please join me in welcoming Mr. Abhishek Surendran. Abhishek is a 2013 EPGP alum. Before that, he did his BE in electronics. He is currently working as a principal in Exfinity Ventures in Bangalore, and his core area is managing investments in enterprise core startups. So Abhishek, over to you.
So I passed out in 2013. So I was part of the EPGP4 program, and so lucky enough I've been able to get into the VC field post EPGP. So what we, so I'm not sure what is the expectation from today's seminar, but Harcharan told me that to give an overview of what VC does, right? So let's keep it very interactive, right? So I'm an ex-alum, or I'm an alum. So just any time you want a question or you have any clarification that you need, just feel free to stop. So how many, so before we start, so how many people are looking at career in high finance? Okay, so high finance is basically a field of finance which is considered to be very prestigious and which comprises of three fields of hedge funds, private equity, and VC, right, venture capital. So if you see most of the MBA programs, at least till recently, if you go to some of the colleges like Harvard, Stanford, and all that, so high finance is the most preferred stream of of career path that a lot of students choose. Okay, so so they are sizable people. So when I still remember when someone came and asked us, when I was doing EPGP, so I was the only one who put the hand up, right? So in that way, it's good to see that at least 4 or 5 hands have gone up. Many of you might be coming from IT field, right? So so I'll try to simplify it so that so there will not be many financial jargons in this. And we'll give an entire overview of what, let me start with an overview of what the opportunities in this particular field is. So it's more about, the seminar will be more about you getting to know what VCs do and what people in private equity do. I'll just give you an overview of that. And if you want something more detailed, let me know and I can just give you some more dope on it. Okay. So the key is that VC and private equity are, so VC is a part of private equity, right? So what private equity means is that investment in private companies. So what do you mean by private companies? Companies which are not listed in the stock market, right? So so some of you might be wondering what is so different, right? So ultimately they are companies. So the key is that in public market companies, the companies are a lot more mature. So you have, there's some tangible revenues, but in private markets, it might not be. In public market, there are, regulators who have, oversee the financials of the particular company, what they're filing, how they're filing. There are a lot of, and you would have also gone through some books, right? Your FRS and all those things. So many of it is applicable and scrutinized more in public companies. Private companies not so, right? So the only thing that they have to do, they have to file on ROC filing in, every year. That's it, and that also is not scrutinized. So the investment in private field, private companies is called private equity, and there's a whole gamut of companies between how funds operate. So at the topmost, you will find mutual funds. I'm sure most of you would have invested in mutual funds. So what mutual funds do is a collective investment, right? So very similar to that is how hedge funds and private equity and VC funds are. So, but it's not like you and me can go and invest in a VC fund, right? So there is a certain requirement that a person who's an accredited investor only can invest in a VC fund. So that means that you need to be a HNI, a high net worth individual. So people with typically net worth of more than $50 million or $100 million invest in these companies. So these companies are not open to anybody and everybody, right? So in mutual funds, you and me can invest. Private equity hedge funds, only certain high net worth individuals can invest. But the nature of the operation is very similar. So you collect money from all these people, and then you make investments in certain companies. It's the so from an overview perspective, it looks very simple, right? So it's all about collecting money from others and investing in companies. But the nature of investment and the kind of job that you do differs from the kind of field that you choose. So if it's a hedge fund, then hedge funds basically do everything, right? So there are hedge funds that invest only in commodities. There are hedge funds that invest only in currencies. There are hedge funds that invest in only real estate. So there are tons and so many variations of hedge funds. There are hedge funds that not only invest in public market, they also do derivatives, right? And similar kind of instruments. So the largest industry in the world is the hedge fund industry, right? It's got trillions and trillions of dollars of AUM under it. Then you get the private equity industry, which in US, private equity means only buyout funds. So what buyout funds means is that, this pool of capital is collected together and then they buy companies, the entire companies, right? So in a mutual fund, you take only say 2 or 3% of a company at the max. But in, buyout firms, they take the entire, say 51% to 75% of the entire company, and then they change the management, they bring their own management, and they run the company, and within 3-4 years, they try to exit out the company. Okay, that's what private equity funds do. VC funds are a subsection of private equity. What VC funds do, they invest in at an early stage of a particular company, right? For example, Flipkart, right? That's the most well-known example in India. So if you have, so Flipkart in 2006 was invested by, seed funded by a fund which is called Seed Fund, Erasmic Fund, and which later got bought out by Axel Partners. So then Axel took it. So these are the early stage funds. Then later Tiger Global came, and then many others. There are some nearly around 100 investors today in Flipkart. But when Flipkart, that is Sachin and Binny Bansal started, there was a certain fund which gave money to them, right? So if you see the, in the entire funnel of how a company raises money, the earliest set of investors are the VCs, okay? And in the VC space, you have, again, a lot of differentiation. There is something called as seed funds. There are other funds called Series A investors, then Series B investors, and so on. So it might be a little confusing, but it's very simple in terms of how they all operate. It's just that, if the function of, if you want to be the first set of investors in a company, then you call it a seed fund, right? So the other aspect that I just want to touch upon to you and to just explain to you what VC really is that, when an entrepreneur, and probably some of you might be wanting to become entrepreneurs. So when you start off, okay, so don't approach VCs directly, right? Because they're not going to invest in you. The first set of investors that you have to approach are called as the FFF, which is the friends, family, and fools, right? So only those people are going to give you money. So please approach them, then raise at least 50 lakhs to a crore within your networks, and try to develop some company with some product. Okay, just showcase the product, and get, if you are lucky enough, try to get 1 or 2 customers. Then next stage comes the angel funds or angel investors. Okay, so there are a cumulative set of, there's a group of people, angel group. There are a lot of angel groups today available, right? Called Indian Angel Network, there are Hyderabad Angel, there are Mumbai angels, Bangalore angels. Then while I was studying in IIM Bangalore, I was heading an angel investment group called as Harvard Angels. That's all the alumni of Harvard were, so we collected all of them, asked them to invest. I'm not sure if IIM is planning to start an angel network, but probably we were thinking, right, of starting an IIM alumni angel network. So what these people do is each of them contribute something like 20 lakhs to 30 lakhs, not much. But then you have around 10, 15 angels, so together they can contribute at least 6 crores. The thumb rule is that you need at least 6 crores to do something meaningful with your particular startup, right? So that's so that's the angel network that comes. The second set of people, then that's when the game starts getting interesting. The next set of people that you go to are the VCs, right? So VCs give you money in between $2 million going up to $20 million, right? So the funds which does typically 20 million and above are called as late stage VCs, whereas the ones that do earlier, they're called as early stage VCs, right? And early stage VCs is a lot more exciting than late stage. In the US, late stage VCs are called as growth capital, right? And it's purely a number junking job, right? It's more about analyzing balance sheets and stuff like that. But with early stage VCs, it's really fun. You get to interact with some of the smartest people in the country. You get to sit on the board of those companies. You get to, because the company is fresh, so it's like a clean slate. You get to write what you want. So you get to, whatever you learned in your MBA program, you get to implement it. So it's a lot more interesting when you work in the early stage VCs. Then, of course, you have the growth capital, as I said, and then you have private equity funds, and then you have hedge funds, and so on and so forth. Correct? So, can we go on? Any questions so far? Anything that I can help you with? Any queries that you have at this moment? So this is a little dated, this particular slide, but I hope that, yeah.
What is the ideal time when someone should approach, or a startup should approach the seed fund level? Are there any metrics when a certain number of steady cash flow or certain number of customers, or is there any indication when?
See, the way you have to think is what kind of startup are you building, right? So if you're building typically VCs are useful for early stage technology ventures, right? They may not be the best source of capital for people to, say IT services, right? So for IT services, it doesn't really matter. So before that, let me just give you an idea of what VCs really expect. So a VC fund, as I said earlier, you pull in a lot of capital, and what we promise to investors is that we'll give you at least 20 to 25% IRR, right? So I believe you would have learned what IRR is for those people who are not from finance backgrounds. So the 20% IRR is something that's the critical standpoint. So if you go to mutual fund, today the expected set of returns are around 10 to 12%. If it's a debt fund, it's around 6 to 7%. If it's a savings bank account, post-tax, it's around 3 to 5%, right? So we tell people we'll give you 20%. Okay. Yes.
Suppose I have a prototype ready and I have some few customers from a new startup. So once I approach the venture capitalist, apart from the factors, apart from the business plan that I have, what parameters do you look at?
I'll come to that. I'm just trying to answer his question.
Another question that I had here was, suppose if an entrepreneur is there who has been successfully bringing, he has already done how does, so when you evaluate as an venture capitalist, how does that particular information get you? Another thing was, once you grant capital, what stake would the venture capitalist have in the startup over
I'll come. So all the questions will be answered, as we go through the presentation, right? But just to answer his question. So at what stage should you approach a VC? That's what his question is. And so I was just giving a prelude to it, and it is something what VCs expect. What VCs expect is that from the time they invest, assume it is T0, to the time they exit, which is T5 to T, that is after 5 years or 6 years, they expect to make at least 10x. Okay, so you invested $1 million in you, they want to get at least $10 million of that. Okay, so that kind of growth potential first you need to show. Okay, and we will also go through why, how do we evaluate some companies, how do we evaluate some sectors and stuff like that. So if your portfolio or your company matches that kind of an growth metric, that is when you should approach a VC. And at what stage will you approach a VC? So you should approach a VC typically when you build a product. Okay, and you have at least 2 to 3 customers. If it is a B2B startup, if it's a B2C startup, then have at least 100 to 200 customers. Okay, at any point, if you are able to demonstrate to an institutional investor that you have a product and that product has hit the product market fit. PMF, which is called a product market fit, is the most abused jargon in VC world. Okay, but what we refer by product market fit is if you have a product that can fit what what the market actually needs, then it's called product market fit. If that you're able to demonstrate, then that's the time that you should go. So that differs from the kind of companies to companies. If you're doing a food tech startup, then you should be able to show your retention rate is at least 30%. If you are doing a B2B startup, say you have a SaaS platform like Freshdesk, you should be able to show that your churn is less than 2%. So it differs, to say, but there are some ground rules for, when you should approach a startup. Yeah, to your question, the long story short is that if you are an entrepreneur who's already been successful, then you will, and it depends on what kind of success. Okay, if you are the Mark Zuckerberg kind of success, then you don't require VC at all. But if you are, say you have made say $1 or $2 million kind of exits in the past, then VCs, they have something called as EIR programs, that is Entrepreneur in Residence programs. So the moment you decide you want to start a company, we'll say, okay, why don't you come and join us? For 1 year, you do whatever you want to do. But whenever you start a company, I will take 30%. Okay, so there are EIR programs. So where did I leave? Yeah, so 2016 has been a bad year for VC, right? So because there's been a lot of in 2015 and 14 there was a lot of money that was thrown in, especially in the B2C side in India, and a lot of companies you would have also read that they have not been able to raise the next round of funding, or they have burnt out all the money and stuff like that. So, but 2017 is seeing a uptick, and especially for B2B ventures. So a lot of B2C ventures are not doing that well. Okay, so these are the criteria for making a VC decision. So the next question that you might have, if you're listening to me, is that, how do we find out companies? Okay. So you will be able to find out, okay, so before that, let me come on. So if you decide to join a VC firm as a career choice, okay, so there are 4 levels of hierarchy in a VC firm. So the bottommost is the analyst. So they are typically the number jockeys. So they help us get, analyze, reports. They help us analyze all the balance sheets and all that. Typically they are pre-MBA. So the first post-MBA role is an associate. So what's an associate role? So typically they are fresh B school grads, again helping people to make deals, in a VC firm to make deals. They lead on the sourcing front. Sourcing means, finding out companies. Then comes principals, who are like the junior partners. of a particular firm. So they lead the investments. And then you have the partners who are actually the promoters who are running the firm, on whose name the funds are being raised. Okay, so these are the four slabs. And the other unfortunate thing about VC is that it's not a very people-intensive job, right? So I mean to say, someone like say TCS or Infosys in India would be, their employee strength each is around nearly 2 lakh and above. But the largest VC fund in India is Sequoia Capital, and you know what's their employee strength? Any guesses? Yeah, it's just 12. Okay. So that's the largest VC fund. So the entire VC industry has got just 160, the last count. So I got a report from one of the headhunters. Just 160 partners / principals. Okay. So there are 25 funds in India, VC funds in India. So it's extremely tough to get into a VC firm. Not because it's hard, it's one of the cool jobs, not much work, but you get paid. So, but the thing is that it's very limited in terms of number of jobs. So getting the job is more a matter of luck. Private equity are a little larger, so there will be at least 1,000 jobs on private equity side. And hedge funds in India is not very large, it's another 1,000. So in India, the total high finance industry, the key roles, the investment roles, because that's investment roles is are the people who call the shots, right, in any VC or any investment firm. And so they're just 2,000, right? So if you really want to make a mark in this particular field, then you need to, to improve your chances, you need to go abroad. So something like Silicon Valley has got a lot of VC firms. So the number of jobs in Silicon Valley is around 2,000 when compared to India's 160 odd VCs, right? Yes. See, they are called CVCs, which is corporate venture capital arms, like Intel Capital, Qualcomm Capital, and stuff like that. But even they also have 2-3 people max. So, but that's not included in the 160. This is a standalone VC firms. Okay. In fact, I would not even suggest you to go to the CVC route. Right? Probably offline we can have it, or I'll cover that at the end. On your what kind of VC firms to target, right? If at all you want to pursue that opportunity. But the good thing about VC is that you get paid well, so which is good, right? So at the analyst level, the starting salaries are 20 to 25 lakhs. At associate level, it is 50 lakhs and so on, right? So someone's like partners make a 7 to 8 crores easily. If you are from Sequoia, then probably 30 crores, 40 crores is what you per annum. No, I'm not kidding. I'm telling you that. But this is on the lower side. You get really paid well when you're in private equity. Yeah, probably at the end I'll ask. So if you are in private equity, some of the largest firms are like KKR, then TPG and all these guys. They all sit on AUMs of more than $50-60 billion. So some of their partners, they make like 1,000 crores, per annum. So the salaries are obscene. Okay. No, see, 1,000 crores is what, around $50 million. Not 50, I think what, $150 million, which is not something that you make one exit, yeah, then you can retire for life. Right? So it's a very well-paying field, a very highly remunerative field, but the number of jobs are limited. So that's the trade-off that you have. So where did I go? So coming to the associates and analysts, they primarily focus on trying to source companies. and the principals and the partners, they do the investments. So how do we make investments? So that's what I just want to cover over here. So the fundamental thing, so if say you are Flipkart, right, and you are coming in 2006 and you are approaching a VC firm saying that you want to invest, so you want funds to raise. So how does a VC firm evaluate that opportunity? So number one and the most tangible way is the team, right? So how good the team is, right? So see, as VCs, we are not the players, right? We are the coach, right? We are the Anil Kumble's and not the Virat Kohli's. And that's very important to make the distinction in your mind. The key is that we help entrepreneurs. So we are a support function. We are a services organization. We provide capital, which is a commodity, and you need to provide something more to the entrepreneurs. Otherwise, you will not be able to succeed in this field, right? So in this field, you should be able to go and convince an entrepreneur to take your money. Because if I give $1 million to that him, and any other VC firm can give the same $1 million, it's just a commodity, right? It's nothing great. But I have to be able to convince. So the best deals, right, when Flipkart had raised its Series A, they had term sheets from all the around 15 or 25 VC firms in India, right? And then they went with Axel partner. Why did they choose Axel? Right? So Axel, of course, is a very good brand name. They were the guys who invested in Facebook, and all the partners there individually have become billionaires because of investing in Facebook. So you can walk the talk at that time. But the key is that as a VC, you should be able to convince an entrepreneur to take your money. Okay, it's a sales job. Okay, though it might not look like that, and you might feel that it's a very glamorous job where people come to you all the time. But it's like that's a very famous joke by Groucho Marx, if you've heard it, right? So you don't want to join a club which accepts you, right? So very similar to that, you don't want to invest in an entrepreneur who takes you money. So you want to invest in a guy who's everyone are running behind. Okay, it's like dating a girl, right? Who's sought after by everyone. So the thing is that we evaluate on a team, and if it's a B2C company, the most important thing is your marketing ability. How are people, do they have a good marketing guy in the founding team? If it's a B2B company, sales is very important. Okay. So the fundamental thing in VC is, or in any startup, is growth. Okay. Profitability does not matter. Because profits, if you want to optimize for profits, then you can't attain VC scale. So what does VC scale mean? That, because if I invest in T0 and if I have to exit in T5 or 6, I need to make 10x, right? So if I have, say, invested in your company at, say, $5 million valuation, that means that I need to exit at around 500 or 1,000 or $1 billion valuations. So you need to grow within just 5-6 years at that kind of scale. That is the fundamental motivation behind choosing a team, behind choosing a kind of an investment that a VC wants to make. And mortality rate in VC is very high, right, which everyone knows. So if you invest in 10 companies, then only 1 or 2 will succeed. 7 to 8 will fail. And even among VC firms, it's very different, right? So only the top 5 to 10% of the funds in the world actually return the capital, right? 90% are unable to do it. So it's a very risky job. But the good thing is that success or failure is determined at the end of 10 years. So for 10 years, no matter how bad you are, you can take a fat paycheck and go. Okay. And you can retire for life, right? So that's a good thing. So how do VCs make money, right? So VCs make money in 2 ways. So one is called the management fee, which you take 2% of the corpus every year. So supposing someone like a Sequoia, right? So they manage $4 billion in India. So $4 billion is 2% is around how much? Around 80 million. So $80 million of revenue they get per year, and they have only 12 people. So you do the math and see how each of them gets salary for that. So the same function is so that's on the management fee, and so that's something that's guaranteed to you. 5 to 6 years. But if you're really lucky and you get to invest in the next Google or the next Facebook, you get 20% of that return, right? So if you're lucky and you invest in a Google, then you can retire as a billionaire. So that's how VCs make 220 principal it's called, 2% on the management fee and 20% on the, it's called carry. So 20% of the profits that a fund makes. Now that's one. And so as I said, the team, so we evaluate on the team. So when you come and meet us, team is very important. So we evaluate. So if you're planning to start a company, even if you're not willing to join a VC firm, you want to do a company or you want to be an entrepreneur, choose your co-founders very, very carefully, right? So do not, choose your friends because you know them well. Choose the people who can add real value to you. In any startup, a good marketing guy, a good sales guy is very important. And the ideal profile of choosing your co-founding team is that you need to have one rock star programmer or technical guy and one rock star marketing or sales guy. So if it is B2B sales, if it is B2C, it is marketing. So this is the ideal set of people. So no VC invest in a single founder because it's too risky. So always have another co-founder. 2 is good, 3 is okay, and after 3 it's a crowd, right? So we don't like to invest beyond 3 co-founders. And so one way is that when you're choosing a co-founder, so we try to evaluate. We take around, it's like a dating game, right? We take around 6 months to evaluate the entrepreneur. We meet them, we discuss their idea, their goals. We try to find what is the motivation of an entrepreneur. We don't invest in mercenary entrepreneurs, we invest in missionary entrepreneurs. What is different with mercenary and missionary? So mercenary is basically a guy who, is just there for the money, right? Or he just sees a quick wave, like, Snapdeal guys, right? So they saw there was, e-commerce was taking off, they went and all that. So missionary guys are people who really want to make a difference. They're willing to stick around for long. So we want to invest in missionary people. And the most important thing is alignment of incentives, because incentives are driving the behaviors of your first level of people who are founding the team and also the second level structures. So even one of the reasons why we want very, very well-read, very good people who are well regarded in that field is because they are able to hire talent which is necessary to scale the company. Correct? So we always look at can this guy, if we're investing in a founder, can this founder attract equally smart people like him? Because the first set of employees will not get market salary, right? They will get a huge pay cut and they will get compensated with ESOP. But you should be able to convince that other person that I'm going to change the world, so you come with me, and this 20% at a later point in time, or this 2 to 3% ESOP at some point in time is going to be very valuable to you. So that convincing skill is very much necessary for an entrepreneur. So if you're an entrepreneur and you want to be an entrepreneur, you need to first ask yourself, can you convince people who are smarter than you to join? Okay, the market. So the most important thing in a market, in a VC investment or any startup investment is the market. So market is a good team in a bad market will still fail. A bad team in a good market can succeed. It can give you an average set of returns. Right? So the most important thing is market. Choose your market carefully. Okay. If you are, if you have certain set of visions about how you want to change the entire ecosystem, and only disruptive solutions can really scale rapidly, right? So if you bring a solution that is just 10% or 20% better than what a competitor is offering, you are never going to scale quickly. It will be on price, it will be a commodity and stuff like that. So if you want to really scale, then you have to give a solution that's 10 times better than what the market is offering. So we always look at markets which are ready, And also another thing is that how do you define a good market, right? So a market which is ready for disruption means a market in which the last 10 years there has been no major disruption and the gross margins are quite high. Okay, they have not decreased over a period of time. So that's how we evaluate if it's a good market or not. And of course, the capital requirement of the life cycle is very important. So we don't want to invest in very capital intensive business like e-commerce, very capital intensive. Like Flipkart has taken more than $8 billion today of capital, but its market cap is only around $10 billion. Right? So it's a very capital inefficient business. But at the same time, compared with Google, right? Google just took $25 million, and when they exited, they gave it a $125 billion market cap. Right? So that's the kind of scale. So technology ventures gives you the kind of scale that no other ventures can do it. But then, Google kind of company comes only once in a lifetime. Or Uber today, not considering the today's fiasco. Okay, so there are three stools when you evaluate an startup. So one is in product and the market and the founders. So we spoke about the first two, and the product is very important. Okay, so this is important at Series A stage. The first two are important at so this is very important at angel stage, right? So when you're first going and raising your first set of capital, people give money only based on team, because that's the only thing you can evaluate on. Then comes the market, because then you build something. So this comes at at seed stage or at pre-series A stage. At series A stage, people evaluate this, right? What is the product? So everyone knows that there is a huge market for, say, fuel that is very cheap and that gives no emissions. Water is the only emission, right? So everyone knows that is, there's a huge market for it. But you have a product to meet such a demand. That is what the product talks about. And what really means in a product, in a B2B, distribution really matters. In B2C, it's only how soon can you market yourself. So brand and marketing plays more importance in B2B, sorry, B2C, and B2B it is more about distribution. How are you going to, are you using feet on street, are you using inside sales, are you using digital marketing? How is it that you're going to scale? And then of course a major part of the VC is also making deals, right? So you have very few people in a VC firm. So every person is expected to, bring a set of entrepreneurs, convince them, and make a deal. So there are a lot of things, but I don't want to bore you with all this. If you're interested, I'll go through. But yeah. So then the most important thing is exit. So after 7-8 years, you need to exit and return the money to your investors. I'm talking from a perspective of VC. So how do you do that? So some of the modes of exit is IPO, which is very rare in India. Then trade sale to a strategic investor, and secondary sale. So trade sale is basically like M&A, right? So today you would have seen Amazon bought Whole Foods, right? So all the VCs who invest in Whole Foods would have got an exit. Then secondary sale, basically there are other private equity firms which specialize only in buying VC assets. So you can sell it to them as well. And the most important thing is you need to plan your exit right from day one. So see, VC is like a game. So some people who are not initiated, it's like horse betting, right? So you have 10 horses, and the good thing in VC is that you get 10 horses to play, right? If you're playing the sweepstakes or with actual horses, then you can bet on only one horse. But here in this case, you can do it on 10 companies and hope some one of them wins. So, but the important thing is to plan your exit, knowing when to sell and whom to sell. If you are able to master this, this is the holy grail of VC. If you are able to master this, then VC becomes a very easy job and you'll become very successful and wealthy also. But very rarely people in India have done that. So once we make an investment, we also sit on the board of companies. We help them, plan. We become like the extended arm to the investors, to the founders. We help them build strategies. We help them, so the three major value addition that we do. We help them get, good set of employees, right, through our networks. Then we help them get good business development opportunities, like opening doors in terms of companies to sell to and all that. And thirdly, we also help them, in certain strategic decisions. Yeah, so just to recap, the most important thing for a VC fund is trust the promoters, take time to invest, then engage the portfolio company, make a successful interventions. And also, many times you would have also read in Economic Times, like for example with Uber's case, wherein Travis, for whatever reason, he built a great company, but it was not with the right culture. So the investors, all the VC investors joined together, they asked him to leave. So you need to crack the whip, right? So as a board member, you are expected to sit and, set the right culture, set the right stage for a company to exit. So that's also a critical function of the VC. So these are the evaluation methods and stuff like that, but again, there's interest I'll go through. But the entire valuation, sometimes some people might be a little perplexed. How did this company with no revenue make, get $100 million or $200 million or $1 billion valuations? The valuation is always, when you're valuing a startup, we call it as a Goldilocks rule, right? So neither too much nor too less. So, it's very hard to value a startup which has got no revenue. So what we always believe is only future, and any investment for the matter is on base of future. Nobody makes investments on base of today. And I think as you go through your course, you'll also understand some valuation tools like DCF and stuff like that, when you value on. But in VC, you will not be using any of them. Okay, so that's all very theoretical. So in VC, you have to make judgments on how much this company will scale, and basically it's all part of the greater fools theory, right? So each fool finds a bigger fool to sell his product and move on. Okay. So the entire investment game is like that. So you just need to find somebody who will pay more than what you have paid in the past, so that you can make a cut out. Yeah, so this was general GAN. And so this is a nutshell about VC, but I'm sure I didn't cover most of it. But if there's something specific, I'm happy to answer. If you have any questions, I'm happy to answer.
A couple of months earlier, there was an article where it was mentioned that Show was the only profitable venture, while all the other startups are either in losses or failing.
Correct.
And that article actually concentrated on that profits are important as compared to profits are important as compared to the growth. So, I mean, it's quite counterintuitive to what you actually said.
No. So what I said is, at the beginning, when you're evaluating a company, growth is what matters, right? So if you have a company that says $10 million, it is profitable, but growing at 5%, and you have another company that's making a revenue of $10 million, but growing at 50% year on year, and not profitable. As a VC, you would bet on that company, which is growing at 50% and not profitable, and $10 million, right? So the key is growth, and for some of these companies that you are talking, that report even I also read. So what they were talking is, in present scenario of, and they were comparing BookMyShow with a Flipkart and with Snapdeal, which has been there for 10 years. After 10 years and after raising tons of money, you are expected to become profitable, right? But at the earlier stage, profitability is not what people evaluate here. It's all about growth and scale. And BookMyShows have been there for donkey's years, right? And today, in fact, BookMyShow, in my opinion, is a very bad investment. And Axel Partners, I know those guys pretty well. They're all crying after investing. The reason is because you have a company with after raising nearly around $600 million, which is just generating a revenue of around $150 million, right? With a margin of such a wafer thin margin, they hardly make. The only way they make money is through some of the convenience fee that you pay, right? And most of the theaters, they don't even pay them also. So the problem with Book My Show is that they just don't know how to scale. That's the maximum. The market is way limited. And if they go to the market, they will not get valued. They will be beaten up very badly when they go IPO. See, the best thing is that, like you can say Instagram, why they were bought, right? They had, around say a billion, not billion, around 100 million users, but they got bought out for $1 billion. And they had no revenue, they had no profit. So, so valuation is typically depend upon how large your market opportunity is, and do you have a product which can satisfy that particular need. Okay. Profitability is for those set of companies like Flipkarts and all that which run on retail. Now retail you are expected to make profit, otherwise you can't sustain. So you have to see it in that context. Don't see it as a general thumb rule.
You spoke of the 220 rule for investors. Can you share some experiences of challenges on the investor side, because this money is coming from somewhere and then expected to go again?
So there are the terminology called LPs, which is limited partners. So limited partners are the people who actually invest in the fund, and there are GPs called general partners who actually run the fund. Okay. So you want to know the experience of LPs.
The challenge is in getting funds from LPs if you do, or maybe if they are already willing to share funds with you, then giving it back at the right time.
Yeah, so that what you're talking is first the initial fundraise and then the exit process. So initial fundraise, I'm going through a similar phase. So it is tough, but at the same time today it is a lot better to raise money from HNIs. But the ideal scenario, and most of the funds, right, large funds, they don't raise money from individuals. They raise money from pension funds, they raise money from insurance funds, they raise money from endowment funds and sovereign wealth funds. So these are the kind of funds that invest in VC fund. So basically it is all timeline, right? So if I invest in a mutual fund, I can't exit within 10 years. The general timeline of an VC fund is 10 years, right? So if I raise money now, after 10 years only I'm expected to return back. And given this long life cycle, only funds like a pension fund which has a 30-year life cycle, or life insurance fund which is a pension fund that's got on 20 years, right? Only these set of funds will invest. Or today the biggest endowment fund which invests in startups, which invest in VC funds, you know which one? No, it is Harvard. So Harvard has got the world's largest endowment fund of around $45 billion. So they have almost invested in almost all the VC funds. So that is one. Now coming back to the second question on returns. See, returns is tough, right? So as I said earlier, only 10% of VC funds have actual return money, and only 5% have return more than what it was promised. But the good thing in VC is that the ones that have done well, it's a very skewed industry. The ones that do well do phenomenally well. The ones that do bad do terribly bad. Okay, you will not find in between companies, because if supposing as a VC I was lucky enough that I found the next Uber or the Google, the IRRs I make is phenomenal. Like for example, you take case of the best performing fund in the world is a fund called as lowercase capital. Lowercase capital. Lowercase capital. Okay. The guy name is Chris Saka. He retired also. He made only one fund. He raised a fund, a small $10 million fund. And then in his fund, he made an investment. He was lucky enough, he made an investment in Uber, Dropbox, Twitter. So, he was lucky enough to do all these. And that $10 million fund is valued at nearly $10 billion, of which his cut was around $2 billion. And then he took the $2 billion and retired. So, that is on the extreme scale, right? If you see his IRR, it will be like nearly around 1000% or something.
He comes on Shark Tank now.
Huh? He comes from Shark Tank. He used to, but so that is an extreme case. But then funds like top value funds. So they're called the big six, which is Sequoia, Axel, Greylock, then KPCB, Benchmark Capital. So these guys are, or Anderson Horowitz, right? So these are the top 6 funds in the US And their IRRs have been like 150% to 200% over the 10-year period. Okay, that means that if you had to invest, if you're lucky enough to invest in the fund $1 million, even as an LP, you would have got back at least 100 million or something. You would have got at least 100x or something. But the point is that it's very tough to invest in those funds. And for example, Sequoia, the next 6 funds are there, so that is till 2021, they've already raised money. Right? So if the investors are crazy, they would just want to invest. But then on the other side of a scale, like a lot of Indian funds are there, even Sequoia's India arm also, they are struggling to raise money because we have not returned back the capital. India has been a bad market, right, to be very frank. China has done very well. Israel is the rock star of VC because a lot of Israeli funds have done tremendously well. And
Hi. We hear that the low interest rates in the US is one of the major driving factors of all the funding that VCs get. How big a risk is that? I saw $127 billion in 1 year. So let's say the
what was the amount invested?
Sorry?
What was the amount invested?
Invested. Right. So let's say the Fed increases the interest rate by 0.5%. What do you think is the impact? How do you think it will play out in India?
See, in my opinion, I don't think it will impact India. The Fed increase or decrease is not going to impact the private equity investments in India. Okay, it will impact the public market or the FII investments in the market because then US becomes a lot more stable and a lot more attractive, so money will flow over. But long-term capital like the VCs will not really suffer. And secondly, the VCs in the US, they promise an IRRs of around 10 to 15%, whereas in India, you promise 20 to 25% because it's a riskier, and second thing is a fast-growing economy, right? So making multiples are easier. And given that, 0.5% is not going to really make a difference. The fundamental problem for India is that we have not been able to give back that 20 to 25%. As a collectively, I said only there are 25 VC funds in India. But there are just 2 funds that have returned more than 25%. One is Safe Partners and another is Axel today. Right? So only these 2 have been able to return or give 25% return. So that is the problem, why Indian VCs are struggling to raise money. Not this Fed. Yes.
So you mentioned about few metrics around which you evaluate the particular entrepreneur or a particular product. So are there any things look much very subjective here. So are there any quantitative measures which have come up to predict the success of a particular venture or a particular idea? So are there any quantitative methods or are there any kind of predictive methods which are present?
No, see, at the early stage, it depends on what stage you come. Okay, at the early stage, there is no mathematical or quantitative approach towards making see, in the entire investment field, so you can't, it's very tough to reduce it to a quant. Right? If that was there, then everyone would have, computers would have replaced it. The problem is that, at early stage, if you are restricting yourself to early stage, are you restricting yourself to early stage or are you talking about mid stage, late stage, what are you doing?
No, as an investment, if I compare investing, if I'm an investor and I am investing in a VC, vis-a-vis I am investing, let's say, in a derivative market. So these markets have some empirical data on the basis of which at least there are a lot of predictions which can be made. Obviously there is nothing is for certainty, but some predictions could be made. But
see, in the VC space or the early stage investments, the only thing that you can, only hardcore evidence that you have are the team and B, the market. Right? Many of the time the product will not be built or the product will be built, it will not be enough to meet that market, there will be multiple pivots and stuff like that. Okay. So in fact, reducing and whatever product that you have to a mathematical or an Excel sheet model has led to a lot of VCs failing. Usually VCs are not run by financial people, right? VCs are run by technical people, people who have strong domain knowledge, people who have strong technical programming knowledges. MBAs also usually don't enter VC. It's only the PEs and above when you have actual mathematical or financial sheets where you can sit and go through it and find it. But in entire private equity space, the most critical aspect that you will evaluate is the market. You will not evaluate on the present state of the company. If you are doing derivatives, then you will do present state and they will be tactical, they are not strategic in nature. Right? Tactical means making any decisions for within 6 months of time frame. Strategic is longer than that. So all VC or PE investments are done from strategic basis. So if you are going to take a 2-year or 3-year view, you will not be looking at what the company is doing today. So you have to estimate the market. To do a lot of market estimation, there are a lot of models available. Okay. But this is again, it's not a, see VC or PE in general is an apprentice job, right? You get it only by experience. Okay, by working, sitting, making mistakes. And the good thing is you make mistakes on other people's money. Right? So that is the best part.
I have a question. So what does the day, a typical day at work look like for you? And what are the key skills that you associate with this kind of a job?
Okay, so my typical day would be, rather than a day, I would say a week, right? So I have invested personally, personal means through the fund, not my money, I don't have that much money. So through the fund, I have done 6 investments. Okay, I lead AI investments in Exfinity Venture Partners. So, out of the 5 days, 2 days I reserve for just for the portfolio companies. So I sit on these 6 companies' boards. So I keep in my calendar. I put around 2 hours per company. Then I speak with the entrepreneur. I try to find what is the problem he's trying to face, or what are the good. But mostly, there will not be nothing good at the early stage. It will only be bad. Either he'll run out of capital, or he will not. His best employee will leave him and go, or he will have a fight with his, co-founder. So these are the challenges. But the good thing is it's very interesting, right? You get to meet different problems and challenges, and you don't get bored because it's 6 companies, 6 different companies, so different set of challenges. So it's very interesting that way. So that are the 2 days. Then one day I reserve only for reading, right? So you need to read a lot. So those people who really like to read, reading will not, some Times of India kind of thing, but more about, TechCrunch, VentureBeat. Then there are very specialized VC journals. Good thing IIMB has got lots. So you can go to the first floor in the library. So, and then pour through some of those beautiful journals that comes out of. So you need to spend a lot of time in reading and educating yourself and knowing what the market is, because you make a fundamental bet on the market. So if you are a futurist when you make an investment, when you are a VC, right? You need to love science fiction. You need to, there are a lot of characteristics that a VC typically has, right? So you need to fundamentally love technology and estimate technology. You don't need to be a programmer kind of person to be good in VC, but you need to, forecast. You need to know because you don't invest in technologies that are good today, because that's too late already. You need to know the market well enough that you can estimate it 5 years down the line, right? So that's why extensive reading is very much required. And then 2 days of the week, the balance 2 days of the week, I only meet entrepreneurs. And a combination of this, right? So meeting entrepreneurs, attending conferences, giving Gyan to some people who are willing to listen is one set of the job. Then the second set is basically to understand the market and to meet a lot of opinion makers, right? So if I need to know if I need to invest, today I know AI is going to become big. I need to go, so I don't have the knowledge of AI, right? So I need to meet people who know that well, understand from them, and understand not the technical aspect, but that's not useful to me, but understand the market aspect. How much will I be able to charge? How much will the product go for? Which product is better on the market? What kind of scalable factor that I need to look for? Right? So these are things. That will not come by sitting in a laptop in front of it. So you need to go out all the time, meet as many people as possible. So this job is useful for those people who love technology and technology from a strategic point of view. It's good for people who love to read, and it is good for people who like to, who love science fiction or something like that, who like to write a lot. So these are soft skills, right? So it's good for all these. It's good if you have this bent of mind. And it's good for people who love to analyze, right? So as I said, we are the coach. Okay, so if a fast bowler comes to you and says that, I want to bowl at like Shoaib Akhtar, you can't go and tell him, go and make a presentation and come and all that, right? So you need to tell him, and you need to be able to have analyzed the bowling action of all the fast bowlers in the world and tell him that, no, your bowling style is not good, this is not good, that is not good. So that is what so you should be able to read everything. So you should have known how Google has scaled, how Facebook has scaled, how these people have scaled. Apply those to this person and then tell him and guide him and show it. Why we should not join a VC? A CVC, okay, corporate venture. See, the CVC in general is a fraud VC, right? So basically, you're not taking a bet, okay, on a company. All CVCs are offshoots of larger firms that are listed in the stock market. Stock market, they will not allow you to invest in non-strategic investments. So if you are, say, Intel Capital, you can only invest in a business, a business which is strategic to Intel. Okay, and Intel is, say, it has around 10 to 15 divisions. And one of the divisions has to buy in. Okay, and if you are a VC and you go and you tell the business guy or the business head or a BU head that you have to invest in this company seems good, you have to invest in them, they will say that I know my job better than you. You please wait, sit over there. That is the practical reality. So what happens is in a CVC, you don't make your independent decisions. Okay, you don't sit on board of companies because as per the SEBI norms and this one, if you are sitting on the board of a company, that means you have a control stake in the company. That means that you have to disclose it to the rest of the world, and you have to there are a lot of shareholders issues and all that keeps coming. So you don't do that. So all that you're doing is you're just doing a postman job. All that you're doing is, okay, there's a deal. If Sequoia or Axel is investing, I'll take that company and go and show it. If people like it, it's fine. If they don't like it, then at least I have a job. Okay, so that's why you're just doing a postman job. So if you don't have your skin in the game, this is not a job for you.
So Abhishek, can you just give an idea of the KPIs for some companies for their growth? Like for Flipkarts and Snapdeals of the world, it's the number of customers or the number of sales they do, number of transactions. For Paytm, it would be like something else, number of transactions done or number of users may be one of the criteria for valuation. So for the investments you have done, so can you just give a brief of what KPIs have been used by you?
See, I do B2B investments in AI space. So what I look for is ARR, that is average annual recurring revenues, or MRR is monthly recurring revenues. So most of the distribution today for a B2B software is through SaaS. SaaS, right? So in SaaS, it's always monthly billing or annual billing rates. So how many people you're adding, how many people you have lost, and what is the cost or what is the spend that you have made to get every incremental dollar, right? So these are the kind of metrics that I look at. So sorry to disappoint you, but then it's very, very dependent on company to company. So if you take case of Flipkart, what is the investors look for? So if it is a Flipkart, you're looking at number of users who are actually making a purchase. Okay, that is a headline metric. But the more important metric is the cost of customer acquisition, or it's called CAC. Okay, Then comes your next set of metrics, which is your cost of servicing that particular customer, logistics cost. What is the unit economics? The most important metric today in the B2C world is unit economics. So what is unit economics? It's basically for per unit of sale that you're doing, what is the gross revenue you're making, right? So, in a way, I feel sometimes the B school curriculum also needs to really get upgraded to evaluate some of these new stage companies. So, unit economics is something that you will never learn in whatever courses we have. But unit economics is the most important way to analyze a B2C investment. Okay. So, everyone knows, and as I have told you, you are expected to make loss initially. But then you can't make loss at the gross margin level. You can make loss at the EBITDA level or below, but not at the gross.
So, what's your take on startups on renewable energy nowadays in India? So they are growing. They were growing in US. Now they have come in India, and people are focusing. So, what's your take on those?
So there has been renewable energy was a big thing till recently, but then the two issues have happened. One is oil has got very cheap. Oil has got pretty cheap, right? So as long as oil was above $100 a barrel, it was a very interesting sector to be in. The governments were giving a lot of subsidies and stuff like that. Today, oil is 40 to 50 dollars per barrel. So the incentive offered to renewable is also reduced. The second thing is that the cost for setting up solar plants have dramatically decreased. Right, so previously per kilowatt, it used to, that is set up the capex used to be around I think $18 or something like that. So today it's come down to $1 to $2, right? So and that China has been predominantly been driving down the entire capex. So the way that you have to analyze is that given the rapid deterioration of some of these, it's become very easy to set up. That entry barriers have dropped down dramatically. There's no entry barrier now into those businesses. They become a commodity. Anybody with some few $1 million with a bank account now can set up a solar plant and get capital. And then you can have the exchange where you can just upload it to the grid and make money. So if you are in the business of manufacturing a solar cell or in renewable energy, the capex portion of it, it's not a great industry to be in because it's getting constantly, commoditized by China. And if you are in the business of generation, that is also getting commoditized because its entry barriers are now very low. So it's, in a long story short is that it's not a great field to be. If you are choosing a career in that field, my suggestion is not to do.
Abhishek, just extending Sherry's question and your answer. We see that trend in the public markets all the time. At the end of the day, like a Suzlon Energy or another solar player or something, we see them as they become commoditized. So in the public markets, the saying is that you buy commodities and sell brands. In the startup world, is something similar existent?
No. So in startup world, we look at brand. We do the opposite. We sell commodities and buy brands because only brands get you an exit. Okay. So the number of IPOs are very, very limited, right? But we are always looking at exits through M&As. Now, if suppose somebody wants to buy a Suzlon, if Suzlon doesn't have a brand, nobody will buy it. If there's a commodity, why do you want to buy a company? So that's why our exits are a lot more possible if we focus on brands and companies that are building brands, either in B2B or B2C world, doesn't matter. Commodities are never preferred in the VC world because the exits is tough. But in PE and hedge funds, it's really useful. So it depends on the business that you want to. If you're in VC, don't do that. If you're in PE hedge funds. Hedge funds, they predominantly do only commodities.
Abhishek, thank you so much for taking out time to come back to the college and for this seminar. This is the first seminar in which we have heard these kinds of figures. Thank you so much. And I would request Neha to present a memento on behalf of our EPGP batch.
Thank you.
Abhishek, would you like to say something?
I've already said so much. What do you want?
Parting comments.
No, it's the only thing that, I just wish they change this mementos, because there's a third moment I'm getting the same thing. So, my suggestion to you is that I was just speaking initially with when I came in, is that not to worry too much about placements. I'm sure a lot of seniors whoever I've met has told the same thing, and I'm just repeating that. Placements will happen. It might not happen in the time frame that you expect, but I believe, and I'm seeing the response in the market on the EPGP program, and it's improving. Right? When we were in the fourth batch, things were not too good, but I still got into the most competitive field. Right? So it's not difficult if you really set your mind to it. Right? But the important thing is that you have to be clear on what you want. That is the most important aspect, because EPGP is not like PGP wherein you're not a commodity product, right? Each of you are individuals, and each of you are expected to have and bring some unique insights into the business that you're going to be hired into. So you must focus on building that insights. So we do a lot of hiring for our startups, and all we expect is, in fact, last year one of our startup also hired somebody from EPGP. But the important thing is we expect people at this level to know a lot more about the market. Right? So you're not going to be hired for your technical skills. You will be hired only for your business building skills or sales skills or strategic skills. So you must own that. And the more important aspect today is that you must choose what industry you want to get into. That is very important to do it today, and you must work towards it. If you decided at the time of placement, you will not, it will be too late. So that's my parting